Welcome to the Virtual CPA Success Show, where we're 100% focused on helping service-based businesses achieve success. Are you a business owner interested in learning how to scale your business? Has your business reached over $1 million in annual revenue? Then this podcast is for you.
Hello and welcome to today's podcast. Today we are excited to hit on a topic that we've wanted to talk about for a while, but we wanted to have a guest that really understood the issue in order to talk about this. So today we are going to talk about value-based pricing with our guest, Geraldine Carter. Geraldine was recently on our Modern CPA podcast, and so we're bringing her back to really talk about this topic. But for our audience, Geraldine, do you want to give a little bit about your background and kind of how you got started understanding the value-based pricing world?
Sure. So, and thank you, Jamie. And hi, Adam. Hi, Jody. It's great to be with you guys. I'm a big fan of both of your shows. So a quick intro is I work one-on-one with CPAs. I'm not a CPA. I'm an engineer by background, by training. And I started a business with a friend. And after 6 years, I went out on my own to become a coach, have a simpler life, and started working with business owners to help them in their own businesses understand their financials, because in the business that I had, I basically fell into the CFO role. So I understood all things financial, the money, math, the forecasting, all the rest. And a number of my colleagues in their own businesses were suffering, not understanding those things. So that's how I got started business coaching. And then a CPA came to me and asked if I would help them in their business. And I did a bit of a record scratch because I thought, wait, do you guys know how everything about business, you get it by osmosis? And they're just CPAs are business owners like everybody else. There's a lot of stuff they know. All of us as business owners have things we don't know and need to learn. So that was my launching point into working one-on-one with CPAs to help them transform their businesses from an overwhelming tax factory into something that's leaner, more profitable, and much more enjoyable to run.
And if you want to hear more about that story, we did that in the other podcast. We talked about, kind of the transformation for Geraldine. It's a really fun story. So make sure to check out that podcast on our Modern CPA show there. But no, I love the introduction. So let's jump right in. Let's just talk about let's first off, I think the important thing to me, and I've been in a lot of value-based pricing conversations, and I feel like one of the most important parts of a value-based pricing conversation is I think you need to define it. So Geraldine, do you mind kind of talking about what we mean by value-based pricing? And I'll let Jody and Adam add any insights they have as well, because I think it's really important. A lot of times it's interesting that people have a different idea of what value-based pricing is. And so Geraldine, I'll let you start with the definition.
Yeah, important question. And I think requires clarification, because in the accounting space, especially, which is where I listen, there's a lack of clarity around what value-based pricing is and is not. And what I hear when I sort of listen softly is basically anything that's not hourly or cost plus is therefore value. And that is not the situation. Value-based pricing requires that you have a one-on-one conversation with your client to understand what is valuable to them. A lot of CPAs and accountants think that stuff that is flat rate is value. And that if you're not having a conversation with your client, you're not assessing the value. So in order to get at value for your clients, it's helpful to think of the 3 questions that you can ask. Why now? Why me? And why this way? And when you ask those questions and you dig at the answers, you'll start to understand what is most valuable to your clients. And then you can quantify that, start assigning a price to that, and then back in to the services and the price that you'll offer relative to the value that it will provide for that client. But if your blanket flat rate pricing, for example, just for CPAs and accountants, business returns, 1040s, and you're flat rating them, that's flat rate. That's not value if you're not having a value conversation.
Great. So Joe, you want to talk about that a little bit on the agency side? So again, for the agencies that are listening to this episode, how would you define value-based pricing for them?
Yeah, so I look at it very similar, but with a little different. I think it's important to know what the services that you're providing and really kind of what the profit you need to have on those services. You need to have a good in-depth knowledge of what you're providing and really how much time it takes. Because when it really comes down to it, there's a time focus on really everything we do. And so with that, we want to make sure that, hey, if we're going to do a flat fee, like kind of what Geraldine saying, making sure that we're profitable on it. But then kind of going a little bit step further, like Geraldine was saying, we had to take a step back when we did our pricing model because not everything is valued the same way. And so, what I mean by that is that, we looked at it and said, hey, how valuable to a client is reconciling their bank accounts, doing the basic accounting stuff. And we found that when people come to us, that's not why they come to us. So that's not the value point. So we can't really increase the price a whole lot on that. So that is what it is. And so we come up with a flat fee for the different service levels that we offer on the accounting side. But what's more important to the client, we found is that the weekly meetings, the hand holdings, the modeling, the forecasting, the KPIs, everything that we can present to them and help them, M&As, profit sharing plans, whatever that is, that's the more value that's the reason why they come to us. And so with those different factors, they've got to have a higher profit margin because that's why they're coming to us. The value is a lot higher to the client. So we've identified what's valuable to the client, and what's not valuable to the client. And then we had to take it even one step further because what we present to $1 million client is a significantly different service than what's presented to a $10 million client. If we presented $1 million price to a $10 million client, they'd laugh at it, or they would, hey, let's sign you up right away. And then you'd find out you're not profitable. So there's got to be a way to scale it. And so we actually, taking those in factors, we took and scaled based on revenue on the CFO side. So the higher the revenue, the more the service costs, and the lower the revenue, conversely. And then on the accounting side, we looked at people. We felt the more people they had, we're going to have, the more they're going to have with, the accounts payable, receivables, that sort of thing. And so we scaled based on people as well as based on revenue to make sure that we provided it. So again, providing the value for the service that we're offering, what they're perceiving versus what I would call the traditional value-based pricing a long time ago is what the end result's going to be. It's really hard to tell. The clients don't know. So it's really hard to say, hey, I think we're going to give this value out in the sky somewhere, and I'm going to charge you that price. It's really hard for clients to comprehend that. And a lot of times they're not really truthful with you on that because they know what you're playing and they're going to try to downsize that. So the traditional model of value-based pricing is a little different than what we do at Summit. And it sounds like it's very similar to what you do and what you coach with your team, correct?
Yeah, I mean, there's a lot in there for sure, and it's not an easy answer, right? So there are a couple of things going on with. It sounds like you're segmenting by revenue, you're segmenting your people, segmenting by revenue, segmenting by how much people, making sure, in essence, that how you price is profitable and that there are certain margins on there, which, of course, from a business standpoint, you want to make sure that what you're selling is profitable. Otherwise, what's the point? Where I think where things get murky is the thing with value pricing is that when you have a single conversation with people, the situation that it sets up is leaving the least amount of profit on the table. But the problem with value pricing by having the one-on-one conversation and then assessing prices after you have that conversation is that it isn't scalable. And with your situation at Summit, you need something that's scalable because you've got so many moving parts and you've got lots of clients. So it makes having a value-based conversation in a traditional sense and assigning specific prices, one price per customer, everybody gets their own price. It presents complications for you. It reduces scalability. It increases friction. So I think what you're doing with segmenting your client base by revenue, by people, enables you to find the sweet spot between the two, where you can have something that is, you're thinking about the value, but you're also leveraging the scalability of something that's more flat rate.
Yeah, and we a la carte it for clients so that they're not buying something that they don't really want, and so it's every client comes to us, it's going to be a different price. It's not a one price fits all model like a lot of flat fee or a lot of tax returns maybe are done that way. It's based on really what the client wants and needs. Do they want somebody to oversee their accounting staff, or do they want somebody to be their accounting staff? Do they want somebody to sit along their CFO or somebody to be their CFO? Those are the different factors that are coming into play when when we do the service, because again, the pricing is going to be completely different because the value is completely different. And so we want to make sure that they're one-on-one, and then annually looking at that and reevaluating, because clients grow at different speeds. So did this client go from 2 million to 10 million in 1 year? If that's the case, then at that anniversary, we need to look at it and plug in, hey, here's what the $10 million amount is, or the $5 million amount. Or if they went backward, here's what the $500,000 amount is. That type of thing is important to constantly look at on an annual basis and make sure that it's followed through.
Great points. So Adam, we've heard two opinions on value-based pricing here, which there are a lot of similarities at, but also it sounds like a couple little small differences there. So Adam, I'm interested in your thoughts on what both Jody and Geraldine just said.
Yeah, obviously I'm swayed a little bit more towards Jody's side in terms of being able to make it scalable. Geraldine, to your point, our intent was to be able to have anybody on our team be able to quote this service, and for our clients to really feel the transparency in what we're doing, and that people weren't being priced based on ability to pay. Because I think a lot of times don't get me wrong, I talk about it all the time with the team internally. It's like, hey, you can say that that's $2,000 because it's going to take us 20 hours all you want or whatever, but at the end of the day, it's not worth $200 to anybody. So we shouldn't do it, so we'll have those kind of conversations. But like I said, at the end of the day, with the clients and the team, we wanted them to feel like on that first initial call that based on what they said in that call, or what their status is in terms of their company or their personal lifestyle, didn't really dictate how we're going to charge them. So we're like, hey, there's a certain value to us being your CFO, or there's a certain value to us overseeing your team. And here's what it is. We understand that there is some modifications based on the size of the company. That's the only thing that we've really kind of seen some indications. That doesn't mean that we don't spend just as much time on a smaller company as we do a large company, or vice versa. But at the end of the day, we kind of have to put we have to kind of put the stake in the ground somewhere. And that's kind of where we've found the most correlation to be for us. And clients really do appreciate that transparency. And I think that's one of the things that helps sell our service the best.
Well, also for me, one of the things that I've always liked about value-based pricing, and again, I may be off base on this, so I'm curious if Geraldine, I'm going down the wrong path here, but like to me, when you talk about value, it's nice to know like a dollar amount of what that actual value is. And so for us, using the CPA firm as an example here, like we know how much it costs to hire a CPA because we do that all the time, right? Like we're always looking for CFOs, we're always looking for accountants, we're always looking for controllers. And so I know exactly how much that I have to pay a CFO or a controller or an accountant. And so when someone comes to me saying, okay, these are the services I want, A, B, C, D, I know how much they're going to have to pay for that to get that full time. And so as long as I know my price is in that range and a little bit less because they're getting it fractional, then I understand the value of that because I'm doing that pricing all the time. And so to me, that I've always made that correlation of like, okay, we're gonna charge you $90,000 a year to do what you just said. But if you had to hire an accountant and a CFO and a controller to do those three things, it's going to cost you $300,000 to do that internally. So I know my $90,000 has value to you because we're doing it fractionally. Is that the right thought there, or am I off base on that in any way?
Okay, so make your question a little smaller so I can track the whole thing, because there's a bunch of stuff in there.
Yeah. So my question is does the fact that I know how much it costs for them to do the services I'm doing directly, if they were to hire someone, makes value-based pricing easier for me because I know how much to charge them. Is that similar to value-based pricing?
Okay, so there are a couple of things in there. So the fact that you know how much it costs helps you be confident in your value of what you're doing, and helps you be confident in your prices, right? And when you're confident in your prices, that gets conveyed to your client, because you can say basically, look, out on the open market, if you're going to hire these people all three piecemeal, here's how much it costs. So relative to that anchor price, what we're doing is a fraction of that cost. That by comparison, this is a great price for you because you get the exact same thing, you get the same value for less money, which makes it more worth it. Right. And that's the ratio, is how much is it worth it? And that's what buyers are thinking about. How much is it worth it? So that's one piece of that. Another piece in there is based on ability to pay. I mean, we're always basing our prices on ability to pay, because if somebody came to you and they only had $10,000 to spend, they wouldn't even, the conversation would go nowhere because they don't have an ability to pay. So with value pricing, where it can get a little bit, it can become unclear, is what I think it's easy not to see is that we are basing our prices already by default on ability to pay. So does that answer your question? Did I get to it?
Yeah, no, I think so. Yeah, like I said, I think that the fact that we understand our value because we see our value every day makes it easier to feel like I'm doing value-based pricing when I'm going into a quote and being like, okay, I know what they would pay for this in the open market, and so there is some value to that. So that's always the way I've been able to define it for me.
And let me tack on one thing, because there's something that you're doing in there that I think is valuable for listeners, is that you have an anchor point that is much higher than your price, right? And the anchor point of the summation of the controller, the CFO, and the accounting team, $300,000. By comparison, your price is a fraction of that, makes it appear more valuable in your buyer's mind. And that's pricing psychology. So having that high anchor point to compare your price to makes the buying decision so much easier when there's a clear spread between the sort of maximum anchor and what your price actually is.
I got a question to you, kind of circling back around to our creative agency space. If we're quoting a job that is maybe typically $300,000 or $1 million or something of that nature, how would you go about value-based pricing based on your modeling on something of that size versus just an accounting fee, which may be smaller, a lot smaller in nature?
So how would I go about value-based, having a pricing conversation? So the place to start is always with, which what we said at the outset, is understanding the value to the client, right? The 3 value questions. Why me? Which sounds like, why are you guys coming to us? Like, why are you even thinking about leaving your old accountant? And they give you a whole host of reasons. They didn't do it on time. Their stuff was a mess. We weren't confident in its accuracy. And then you can go with, and you want to dig into those questions, right? Because you want to understand what's important that they think you have that they weren't getting at their previous firm. And then with why now, like, why not wait 6 months and see if this problem goes away? Like, why not do this 6 months ago? What prevented you from calling us then? Did you not have the cash flow? And so on. So you want to understand, why is it important that it happen now? Why is this urgent? Are you looking at occupying a new space? Are you looking at expanding? Is your revenue shrinking and you're worried about it and you want to get on top of it before it's too late? And they'll give you a whole host of reasons why it's important to do it now. And then why in this manner? Why do it with us? Why not outsource? Why not outsource it to somebody else? There's a bunch of people who offer VCFO services, not as good as ours, but why not do it with one of them? Or why not have it in-house? Why not hire your own people? And they'll say, oh, we hired somebody in-house. They were terrible. We don't like managing staff. They'll give you all the reasons. And you want to dig at the ones that seem most salient to understand why they're coming to you instead of somebody else. Why now instead of waiting? And why this way instead of, just going to bench.com or, I don't know, Fathom and cooking up their QuickBooks and doing that all themselves. And they will tell you all the reasons why they can't do it. And from there, you can back into the value and start to quantify why it's important that they work with you now. And you can pin, back to Jamie's point, a high price. Like, if we could do all these things for you and get all this lined out and have it done by this certain date, so you could go to the bank for your loan, what would that be worth to you? And you employ a sort of pricing trick, which is pin an arbitrarily absurdly high price just so you can back in. Say, like, would that be worth, I don't know, I'm just playing here, $1 million, $100,000, $50,000, $50? And then they've got a window. They, oh, no. But like, we would definitely, like, I don't know, $75,000, $90,000 definitely be worth it. So that's how, this is where value pricing becomes the art and not the science, because there's a ton of squishiness in there. But that's how you can systematically think about beginning to assign a value price to these sort of intangible pieces that are not necessarily directly financially related. But that's how you can start getting close to a price.
And I think, to Jody's question, like thinking about that in terms of an agency, whether it's a website design, a whole new marketing program that's completely integrated with web. I think like those three questions, as you were going through them, I was thinking about how my clients would have answered those. And I think there's a lot of really good things to unpack there. And I know, Adam, you work with agencies quite a bit. Do you want to give some examples of some things they might be seeing in terms of those three value-based questions?
Yeah, I mean, I think they start out that way. I think one of the things that they get a little bit hung up on is, everybody's kind of got a budget, and so how do you kind of counter that or tackle that whenever you're doing value-based pricing, Geraldine? Because that's, for a lot of agencies, again, that's what they're kind of coming into, and there's a lot of moving pieces. So, they might have 8 or 4 to 5, 6 to 8 people on a project at once. So how does that kind of go into value-based pricing?
So providing a menu of options, right? As Alan Weiss likes to say, a choice of yeses, so that you're giving them 3 options, not 5, not 2, so that they can compare and they feel like they are making an informed choice about which option works for them within their budget. And when you have that value-based conversation and you understand what their most important outcomes are, then you reverse engineer your services that will all satisfy those outcomes, right? So just in simple terms, just say I had a transportation company. Somebody came to me and said, hey, I want to get across town. You can say, great, for $10,000, I'll drive you across town right now in my Lexus. For $5,000, you can take this Toyota. It's the exact same car with a different emblem on the front. Here's a map. And for $50, here's a bike. It's a beautiful day. It's all flat. It's 5 miles. It'll take you 30 minutes to get there. Which one do you want? They all get you across town. They meet the exact same outcome, the exact same desired outcome. But the client gets to choose based on how much they have to spend and how much style they want to travel in, if you will. So for your creative agencies, focus on the outcome with the value conversation. That's how you get there. And then you back in with 3 services at, let's just say the budget is $45,000. You can put one that's really valuable at 50 above their budget. If it's valuable, people will go above their budget when they see the value. Then you can have another one at $22,000 and another one at $10,000, right? You can use, there's a pricing curve in there, embedded in there. That one's Goldilocks, 1x, 2.2x, 5x, to spread your services out so that they've got a menu they can choose from, all of which, this is important, all of which satisfy their outcome. And you, as the provider, design the service so that it is still profitable for you. That way, you're providing a service in which it's profitable for both parties.
I think that the really good point you made there was right at the end. I think that the important part of selling in that way is understanding how all 3 meet their needs. And I think to your point earlier is like, you have to understand what those needs are and what those questions are coming into that sales call. So if they define, this is the 3 things we need, you can say, well, I can meet those 3 things in 3 different ways. And let me explain the difference. Like this one package here is going to meet those needs in this way. And it's going to be this, and this is how it's going to meet the needs, but you're getting all these extra things that are going to exceed those needs. And then the middle one is obviously this is how it meets your needs. And these are those 3 things above. This is why you might not need them and might not want them. And so really being able to explain that at each package level is kind of the art of sale in a lot of ways.
And an important piece in here with value-based pricing is that oftentimes it works best. It's easiest to wrap your head around with projects. Single discrete projects with a clear beginning, a clear middle, and a clear end. So if that's, that's worth at least $10,000, otherwise it's not worth your time to have the conversation to begin with, just because it's an involved conversation. So if you think about just in terms of projects with value-based pricing, that's the easiest place to start. And then once you get good at it, you can kind of map it over to your recurring revenue streams. But I would say it's harder to start with your recurring revenue streams because it's a little harder to get your brain around it.
So Jody, obviously we sell the recurring revenue streams. That's where we started. So you want to touch on that at all in terms of like recurring revenue? And we touched about a little bit earlier, but recurring revenue and value-based pricing and kind of the difficulties that we may have experienced.
Yeah, sure. So back in roughly 2004 is when we actually started implementing what we call subscription-based billing, which is again a reoccurring revenue stream for virtual CFO services, and we did it in a similar manner or a similar positioning as if we were hiring an employee. When you hire an employee, you're paying them on a biweekly basis or weekly basis or monthly basis, probably not a monthly basis, but you're paying them on a regular basis for that service that they're providing. And so we look at it in a similar manner to which we were going to provide a service-based company like ours on a recurring revenue model like we did on a perpetual basis, meaning that the client can cancel really anytime they want. So if they are in 3 weeks into the engagement, because we actually do it on a weekly basis. So we zap their account every Monday, for the fee for the coming up week. And the engagement's perpetual. So if they decide they want to change scope and engagement, at that point, the engagement refocuses, the price changes, scope changes. At the end of the year, we evaluate again how big the client is. So if the client grew or shrank, our fee will adjust accordingly. And so we have those touch points throughout that engagement to make sure that we on the long term are not going to lose out, and the client on the long term is not going to lose out as well. So it's a win-win for both. And it's similar to an employee arrangement. At the end of the year, they get a raise or they don't get a raise. The same thing with us. As the company grows, our fee will increase. And so the key there is making it perpetual. So that the client knows, hey, similar type of thing. If things are going south, I can, pull the plug on you right now. And we're cool with that because, again, that's the idea. We want to make sure that we continue to provide value. Over time, we find clients stay with us for 4+ years, and the model works extremely well. When we went to the point where it was just a monthly basis, or you do a project, you're not sticking with the client because the client's not meeting with you on a regular weekly basis anymore. So the key is just being that stickiness with the client, making sure that it's perpetual, and making sure that you're providing a solid service at any time. And I think it kind of goes back to, when you're providing all this, do you really know if you're providing that service? I think that's where it comes into constantly pulling your clients and constantly pulling your employees to saying, hey, do you feel the client is getting the service that they need? And then on the client side, do you feel like they're getting the service from our team? So that throughout that process, if things are going south, you know about it right away and you can kind of fix the problem. So again, it continues to build trust with the client that, hey, this is a long-term relationship, not something short-term that they're used to having, from an accounting firm or from a different advisory point.
Great. I think that's a great example. I think the biggest part of that is a lot of those lessons were learned along the way. I know a lot of things that, again, in my 6 years here at Summit, like the way we were doing things back then is definitely changed over time. And there's certain things we've added. And I think one of the things you mentioned is the, evaluating the businesses every year, looking at, okay, has the revenue grown? And then I think the other thing that we added was, and I think we always had this, but it's more communicating it, is giving the team, the CFOs, the accountants, the ability to change pricing throughout. I think a lot of times that's something that a team might not have at other companies. And so like to be aware that, okay, if they just added services A, B, and C, you don't need to do it out of scope. You need to make sure you have that conversation with them right away if they want those services, that this is what the price is going to change to. So giving that right to your team to be able to have those conversations has been important for us as well in terms of that. So we are getting pretty close on time here. So I don't want to open up a brand new topic, but I do want to kind of get some final thoughts on value-based pricing. I know it's been very successful for us. And I know quite a few agencies I work with really have understood this, and it's really changed their business in a lot of ways. So again, we'll start with our guests, and then we'll go around the corner, around the room. But Geraldine, any final thoughts on value-based pricing that we may have not touched in this 30 minutes?
Yeah, I would say the most important thing to remember is that your costs should be decoupled from your prices, right? Because you want to make sure that you're profitable, of course, obviously, but decouple that from the value that you're creating and set prices relative to the value and divorce it from your costs. Okay,
that's definitely a great point. Adam, over to you.
I was going to say, and remember to do the opposite of that. I'll be the Debbie Downer on the accounting side. Value-based pricing doesn't mean you get away from time tracking and understanding your resources and understanding your costs. So it it is an evergreen process. Like, you're going to always be learning and changing, and values going to change over time. And there's going to be some things that maybe just aren't worth doing. The value's not going to be there. So that's why just taking a step back and looking at and analyzing your cost on a regular basis and maintaining your own company is important, whether you're an agency or an accounting firm. I think it goes a long way.
Great point. All right, Jody, I'll throw it over to you to finish this off.
Kind of looking at both. Again, it's important, as Geraldine mentioned, make sure you know what your costs are. I mean, that's important, because you don't want to obviously sell something that maybe has little value and the value is lower than the cost. That would be a bad thing, obviously, unless it's coupled into something else. So knowing what that cost is, the profit margin is, but then from there, looking and seeing from now I know what my cost is, my break even, what I have to sell it for at a minimum. Then what's the value to the client? Is the value tremendous? Is it significantly bigger? Then that needs to be priced significantly more. Is the value something that they can get from the person next door? And it's a commoditized thing. Well, maybe not as much. Maybe that doesn't have a significant jump. So you really need to know what the value is for the client, and that value is going to really help you dictate the price. But again, like Adam mentioned, you always want to look at it. Time tracking is so important, because you're not charging by the hour, but what you're doing is you're going back and reassessing really what is your team doing. And, as you scale and grow, your team may be doing it 5 different ways. And it's important for you to figure that out, and seeing the profit margin, you kind of tell, is this person's profit margin always low because they're doing it the old way versus the new way that the other 4 people are doing it. And so again, it gives you that education point where you can go back and see, hey, where's the process broken here? What tools aren't they using? Really to kind of help make that, and then to reevaluate your pricing all the time. Just because you set it in stone today doesn't mean that 2 years later, a year later, you can't go back and start adjusting things to make sure that they fit the mold.
Yeah, no, all great points. And I think just to add to that is, I think, a big part of this is there's so much education that goes into sales. If your salespeople don't understand what Jody just talked about, that, okay, product A is my most profitable product, then, they're not going to try to sell to that one. Or, maybe we'll sell product C because it's a lower profit, but this client, if we do a really good job on C, we're going to get A, and we're going to get those high profit margins. And so your salespeople need to understand all of that information, and you need to have those conversations with them. And a salesperson just can't be a fancy talker who's good at closing deals. And you want to make sure they understand all that information in order to be successful and help your company be successful. So great points. Appreciate having all 3 of you on today. I think that was an awesome discussion that our listeners are really going to enjoy. So thanks for joining us.
Jamie, Jody, Adam, thanks so much for having me.
Yes,
thank you.
Enjoy this podcast? Visit our website at summitcpa.net to get more tips and strategies for achieving business success. We're here to be a resource in this ever-changing industry.